Hey, Joe, I hear we have a really great show today, don't we?
We have our first guest, a lender I know very well named Trish Reedy. She is a mortgage broker with Trusted Lending Center. And I've known her for quite some time, at least 10 years. And so she's been at it a long time, knows a lot, got a lot of questions for her because there's a lot going on with mortgages right now. Here's me talking to Trish. Not going to hear much of Brian on this because I gave him a coloring book to play with while we're talking grown-up stuff. But here is our interview with Trish Reedy. Trish, how are you?
Doing great. I'm excited to be the first guest.
Well, hey, there's a lot going on with mortgages right now, and I know there's a lot of ground to cover. There's a lot that's moving fast, so there's some specifics I know we can't get into. But as of this recording, the Fed has met this week and raised rates, but mortgages aren't necessarily the same as Fed rates, right?
Correct. That is a super common misconception. So this week, the Fed raised rates 3/4 of a point. And interestingly, that made mortgage rates actually drop.
Interesting.
So quite often, they're actually inversely related. Yep. And it's a super common misconception.
Yeah, we'll kind of just leave it at that because deeper into what gets into a mortgage rate, I mean, there's all sorts of things like terms I don't understand. Like, isn't there a British index called the LIBOR that it's tied to and things like that?
All sorts of things.
All sorts. So it's a very rich tapestry. And, so it's a complicated thing. So yeah, in some cases it moves in sympathy with the Fed, but others not. But fair to say, big picture, they are ascending though, right?
Absolutely. And this past week has been unprecedented territory. I mean, let's be real honest. The past 2 to 3 years has been unprecedented territory, but particularly this past week, we have seen rates move more than we have seen ever, up and down both. And I mean, in 2 days, we probably saw rates move a full point. And then in another 2 days, almost a full point back. That doesn't happen typically. And, things generally happen a lot slower. Rates did jump quite a bit very quickly the past 6 months. And everyone now expects that things are going to continue to go up. The question is how much and how fast and how long will they stay there? So
you're talking about, you kind of hit on it there, but while we're kind of in this area, we'll talk a little bit about the historical context. And you have been a mortgage lender for a while. I think I met you around 2010. And so you've been in it at least that long. And I think you're a little younger than me. So this has pretty much been your career then, hasn't it?
Yes. Yeah. I did a little bit of other industry prior to this. But yeah, I've been doing this a long time now. Seen a little bit of everything. And it's rapidly changing all the time.
I think when we met, like, I could ask you what a rate would be, and it would a few weeks later, it would be pretty close to that. But it's the volatility. I don't know, it's probably sometime around 2012, 13, 14, somewhere in that range. Mortgage rates and just the real estate market in general just became a lot more volatile.
Yeah. I mean, when the housing market crashed in 2008, 2009, things changed, and then they have just evolved ever since. I would say, between 12 and 2019, things were relatively stable, at least compared to the last couple of years. But man, rates in the past couple of years, I think everybody has kind of gotten used to the fact that rates were in the 2s and 3s. And that is so far from normal in historical context.
Yeah.
And where we are now is normal, but it just, after a couple years in 2s and 3s, everybody thinks it's just astronomical. It's not.
Yeah. Well, with rates going up, are you seeing more people doing stuff like, I hear the term buying a point. Is that something more of your clients are doing? And is there a kind of a quick explanation of what that is? It's basically buying down your interest rate at closing, but is it,
right?
Does point equal whole percentage point, or is that a different term? And is that truly something a lot more people are doing with rates up there?
I would say most of my clients are not.
Okay.
And that is usually because most of them do not have more cash up front to put down. There is a common misconception that you have to have 20% down payment to buy a house.
Oh, yeah.
Not true at all. There's a lot of cases where you can do it with no money down, and other cases where you could do it with 3% or 5% down. So very often a first-time home buyer does not have deep pockets.
Right.
So buying a point isn't an option.
Okay.
So for those who don't know, when you pay a point, it means you're going to pay some upfront interest as part of your closing costs.
Okay.
It doesn't have to be a full percentage point. And this is a percent of your loan amount. So if you're borrowing $100,000, 1 point would be $1,000.
Okay.
But, as home values have gone up, loan amounts have gone up. So buying a point has gotten more expensive. But you don't have to buy a full point. It could be any percentage of that. And it also doesn't mean that you're going to buy down your rate from 6% down to 5%.
Okay.
It could cost a full point to go from 6% to 5.75. That's all dependent on the market and what's going on in the market and the cost to get a rate at the time that you lock in. So everything is variable, and it's all dependent on the lender, what the market's doing, how your lender's priced. And then when we go to lock in a client, that is always something that we consider, because if it makes sense, if this is going to be your forever house and you think you're going to be in this loan for 30 years, of course you want to have the lowest rate possible. Now, typically, most people are in their house for 7 or 8 years is average, I think.
Thereabouts, yeah.
And then, especially in the past decade, most people are in their loan for 2 or 3 years before they refinance. So, we think, I need to have the lowest rate possible. Your rate really isn't actually that important, because you're probably not going to be in this loan for all that long. So if you spend all this money on upfront interest, we got to make sure that it's really going to serve you, and you're going to get that, benefit down the road by having a lower mortgage payment.
Right.
So if you're spending $5,000 in points and you're going to save $100 a month, do that math. That's a lot of months to recoup that cost.
Yeah.
Is it worth it? Are you still going to be in this house? Are you still going to be in this loan? And if you are, is it worth that risk to you? Do you have the cash available? We're going to weigh the pros and cons and make that decision together.
Well, one more kind of different mortgage option I've been hearing a little bit more about. I don't know if it's something your clients are going for, but there is a type of mortgage called an ARM, adjustable rate mortgage. I've heard the term a little bit more. I don't know if many people are actually commencing on these loans and actually going through with getting them. ARM was kind of a dirty word for a little while when rates would reset a lot higher, and a lot of subprime buyers had them, and their rates went above where they were qualified. Am I correct there? Wasn't that kind of part of the crisis that got people out of their homes? Too many people had ARMs, but
right.
Is that something that's coming back, an adjustable rate mortgage, or is that still kind of a peripheral product out there?
I think it's going to, as rates continue to go up. Part of the problem was that people would use ARMs to qualify for a more expensive house, a more expensive loan than they really should have. Because typically an adjustable rate mortgage is going to have a smaller payment and a lower rate. So your payment's smaller for a certain amount of time until it adjusts and becomes bigger. So if you start out at 5% for the first 5 years, well, after 5 years, the rate's going to adjust and it's going to, go up to 7% or 9%. And if you aren't prepared for that and you can't afford that higher mortgage payment, well, there's a chance you're going to get foreclosed on.
Yeah.
And that's part of what caused the crash, is people weren't prepared for that. They couldn't actually afford the more expensive mortgage payment.
Yeah.
Well, now I think everyone is more aware of that. And If you're using it as a tool and you're using it correctly, then hey, I'm going to do a 5-year ARM. I know that this house is a place I'm going to live for 5 or 6 years. So doing a 5-year adjustable rate mortgage is smart because my payment's going to be lower. Now, if I plan to be here 10 years, maybe I'm going to screw myself because my payment's going to go up for those last 5 years. But maybe I'm willing to take that risk.
And that scenario you are describing, the term for it is a 5-1 ARM. And there's 7-1 ARMs and 10-1 ARMs. And basically you're in it at one rate for 5 years and then it can reset after that. Is that okay? That's cool. Correct. So, okay.
And right now, there are not a lot of lenders that have super attractive adjustable rate pricing, especially during the pandemic when everything was so low. There was no point in doing them.
Right.
So nobody really wanted them. I think we're going to start seeing them coming back more. My favorite lenders right now have priced themselves out of adjustable rates. They're the same as fixed right now, or maybe a quarter or an eighth of a point better. That's not worth the risk to me to go adjustable if you're only going to be slightly better. Mm-hmm. But if you're going to have significantly lower rate, then it does make a lot of sense.
So kind of going over all of those, just kind of letting people know there are things out there other than the 30-year conventional mortgage, though that's still the bread and butter. But this is where I say, if you're looking at a mortgage, talk to your lender and see which scenario is best for you. Because every situation is very different. People's debt to income, and this is kind of leading into my next question. So, what are the factors when you're, I guess, basically starting the application process and then going into kind of picking which product's right for you? I know that you kind of start with an application and then it goes to you to look at what debt to income and total.
Yeah. The first thing that I'm going to look at is your credit report. What's your credit score? What debts do you have? Are you delinquent on anything? Do you have any judgments, any bankruptcies, anything like that? And then we're going to look at your employment and what type of income you have. Are you self-employed? Do you have hourly income? Do you have a salary? Do you get any bonuses or commission? And we're going to calculate your income based on that. We're going to look at your bank statements and figure out how much cash you have available for a down payment. And also of that available cash, how much of it do you actually want to use? You may have $100,000 available, but tell me, I really only want to use 20 grand. There's a big difference there in what you have and what you're willing. Yeah. And that's a totally different scenario. And then we're going to look at your debt to income ratio. So of the debts that show up on your credit report, we're going to look at all of the minimum payments and compare that to your gross monthly income. So if you make $10,000 a month as a household, then you will typically qualify on a regular vanilla conventional loan for roughly $4,500 to $5,000 a month in debts, including your new house, your car payments, your student loans, your credit cards, anything that shows up on your credit report, plus any child support, alimony, anything that's court ordered.
So when somebody, whether they're a first-time buyer, or I guess even if you're a second or third-time buyer, you don't do this process all the time. So it's kind of new every time you do it. But what are some steps to take? I'm sure you have a checklist you give people, but are there some steps people should take even before they call you to start the application process? And what are some of the mistakes people make that you would in the application process that people should avoid?
So the first thing I would say is make sure you have your credit in line. Mm-hmm. I have clients that call me all the time. Oh, Credit Karma tells me my score is XYZ. I don't trust Credit Karma at all. I have seen it be 100 points off, both positively and negatively. If you want to check your credit, go to annualcreditreport.com. It is the one place online that is accurate and free. Every other place, they're trying to sell you something. So annualcreditreport.com is the one place online that you can trust.
Thank you for giving that out. Because sometimes I want to check, and it's like, oh, is this a safe place to enter my information?
Right.
Right. But now,
in the past, you used to be able to check it there once a year. Once the pandemic started, you can do it monthly.
Okay.
And I believe that's still going on.
Do you know if that counts as a pull on your credit? It does?
It does not.
It does not. Okay. So, because that's another factor that can actually ding your credit scores, having it pulled too many times, right?
Yeah. And typically the people that worry about that are the people that do not need to worry about that.
Okay.
That's what I found.
Yeah. So
that'd be the first thing I would say is make sure you're taking care of everything on your credit. If you're paying your bills on time, if you have the collections that I see most often are medical bills. Typically, they're things that people didn't even know they had. So make sure you're paying your medical bills. And then when it comes time to do your application, we do those all online. Most lenders will do them online, at least to start. I love having conversations with people before they do that, just so we can kind of figure out, are you really ready for this stage? Is there other things you need to do first? Or are you really in that correct life stage yet? Do you have enough saved? Have you been in your job long enough? I can usually get to, are we going to have somebody qualified or not, in a pretty quick phone call.
Yeah. So as excited as like somebody who graduated college 2 weeks ago and just started their job a week ago, they may not be ready to buy yet, right?
But they might be.
They might be. That's true.
They might, or they might not. It just totally depends on their situation.
Yeah. So, so if somebody like got denied for a mortgage, do you usually have some steps they can take to maybe kind of come back around 6 months, a year later, something like that?
Absolutely. And that's something that we go over with everybody that comes through the door. I always say it's never too soon to try to get pre-approved. First of all, you never know when the right house is coming. And second of all, you don't know what you don't know. So you may find out that you had this random medical collection that you didn't know, that you just need to call in and pay and get removed. That may take 3 months to actually happen because of the way the system works. Or you may find out, gosh, I really just need to wait for my next annual bonus to come in, or I need to save something, or I need to make sure that I went to the boats 2 weeks ago and had this big winning, and that's great and all, but then I deposited all this cash. And if I show that to the underwriter, I'm going to shoot myself in the foot. So I need to wait another couple weeks before I go under contract. So it's never too soon to get pre-approved.
So now you have a lot of different options you can offer people. Now you work for a company that do you guys service your own loans? Do you actually keep the debt or?
So we are a broker. So
okay, that's right.
I have so many different places I can send your loan, and they will all keep and retain servicing, and I can continue to be the contact going forward. So once you're my client forever.
So you can literally shop on a computer screen different offers from different lending institutions. So that give you some tools to maybe get some people approved that are in difficult situations. I don't want to say that you've got like special tricks, but maybe more tools that you can work with. And I don't know if you can get too into like maybe somebody who just had been denied somewhere else you got through or something like that, or have you? Yeah, I mean, we've experienced with that.
We've got so many different lenders, and they all have different appetites for what they're looking for. So, if I've got somebody now who wants to refinance just a rental property, and he doesn't want to do it with any of his regular job income, so we've got a program that we can do just for that.
Oh wow!
There's all sorts of different things. They're called non-QM, non-qualified mortgages. And they're generally speaking not quite as fun and easy as a regular conventional loan, but it doesn't mean they're not doable.
Yeah. I don't know. I think all mortgages are fun, Trish. I think
you're one of those rare ones, I guess.
Yeah. So you've got a few areas of expertise. Then you've got the owner occupant. You work with investors. I suppose you've probably loaned on land, things like that. All different. Did it all. I know. What would you say? Maybe I don't know. What something that just came to mind as I was asking that question is condominiums. Is that kind of a little bit the most different residential animal than some of the others, because you have to worry about things like how many units in the complex are rentals versus owner occupied and things like that.
They can be. Yeah, they can be. There's a whole condo questionnaire that the Homes Association has to fill out. And if the condo association itself doesn't qualify, that could potentially disqualify the borrower from buying it. So we've had condo associations in the past that have just been hellish to work with because they don't want to give the paperwork that's required. And it's not required from us or from our company. It's required from Fannie Mae and Freddie Mac. Yeah. But if they don't run the association in a certain way, it could damage their potential buyers and sellers.
Yeah, they have to show things like the cash reserves and things like that.
Right, exactly.
That's is that kind of to guarantee that somebody who's being approved for a payment, their HOA isn't going to go up $300 because the reserves aren't there, and suddenly I don't know if that would technically be debt to income, but it
could be that, or it could be, if they don't have cash reserves, then if they got sued, then potentially homeowners could get sued and there could be another lien on the property. It could be all sorts of different reasons. So the lender wants to protect its interest in the property.
Yeah. Well, and that kind of brings me back around to one of the things you mentioned early in the conversation was sometimes people think they have to have 20% down to buy a home, and you had mentioned 3.5% and 5%. And it was about a conventional loan. 5% is about as low as you can go. Anything lower than 3%.
That is 3%.
Okay. Oh, wow. Okay. So there's a misconception of mine you just shot through. So awesome. And then FHA.
FHA is 3.5%. Mm-hmm.
Well, that's interesting. I always thought of FHA as the lower down payment, but you can go 3% on conventional, but FHA is 3.5%. That's
yeah.
Wow.
And depending on your credit score, one or the other would be better. And I decide that because mortgage insurance is either more or less expensive in one or the other types of loans based on your credit score.
That was what was leading me to that 20% is usually what gets you out of what's called private mortgage insurance, and kind of going back to the lender wants their asset protected. That's something that's on your PMI, or private mortgage insurance is something that's on your loan, your monthly payment, until you reach a certain amount of equity. Is that correct? Exactly. Am I describing that right? Okay.
Exactly. And it protects the lender if you were to default on the loan, but you're the lucky one that gets to pay it.
So for people who have been in their homes a while, kind of watch that. Maybe when you get to that 80 or 20% equity threshold, watch your monthly payment.
Oh, your servicer. Ask, can I get my PMI removed? Yeah. A lot of people at this point in time, if you've been in your house a few years, homes have appreciated so much, you most likely can.
Oh, so maybe somebody who's only been a couple years, because
there's a good chance.
Wow. Mm-hmm. Okay. Is that not usually an automatic thing? Is that something you usually have to call your servicer to?
Yep.
Okay. So
they're going to keep getting that money as long as they can.
And that goes right into your pocket, right, Trish?
I wish. Oh gosh. I wish.
I see you throwing around all that PMI money, Yeah. Well, kind of pulling on that thread a little bit, talking about needing 20% down. Are there some other common misconceptions people have when they come to you and get into the process and they're like, oh, this is not at all what I thought it would be? Are there common ones, or are there maybe funny ones that really stick out that you've seen recently or anything like that?
Oh gosh. I mean, it's different on every deal. First of all, I do not control the appraisal or the appraiser. Mm-hmm. In fact, I am not even allowed to speak to them.
Oh.
So if the house If the house value comes in high or low, I had nothing to do with it. It's not my fault.
Yeah.
I don't get credit for it either. They are completely independent, and we've actually had a lot of loans lately that have had appraisal waivers and haven't even had appraisals required, which is great. Saves the buyer $500 or $600 and saves time. But when in the market that we've been in the past couple of years, when sellers have so many offers coming in and a buyer is willing to pay over asking price, there's a good chance that they're willing to pay more than the property is actually worth.
Yeah.
So just because you're willing to pay it doesn't mean the house is actually going to appraise. And that could potentially cause an issue with your loan. Doesn't mean that it's going to be a deal breaker, but you need a good loan officer that knows what they're doing so that it doesn't kill your deal.
Yeah. Now, when you use the term appraisal waiver, that is the buyer of the home saying, hey, if it doesn't appraise, we'll make up the difference, because there may still be an appraisal, because isn't that typically a lender requirement?
Well, so from your perspective as the realtor, you would define it that way. I define it as Fannie and Freddie don't require the appraisal.
Oh.
And we as the lender do not require it.
So somebody could...
We've had lots of those.
Wow. People have gotten loans without an appraisal at all?
An appraisal at all. Yep.
Wow. Okay. This really is a wild market then.
Yeah. It's been great.
Yeah. Well, so let's see, going through my list of questions for you here. Anything you guys offer just besides the home loans, HELOCs, refi, stuff like that?
No, we've done lots of refinancing, and I think we're going to continue, even with rates going up, I think we're going to continue to do that, particularly as the Fed raises the prime rate. That means the loans on your credit cards, your auto loans, any of those personal loans, those rates are going to rise. So if you have equity in your house, but you also have a lot of credit card debt, consolidating that debt into a home loan is probably a really smart move. Even if you're going to pay 6, 7, 8% on your mortgage, whatever the case may be, that's so much better than 20% on a credit card. I mean, so much better. So if you think about consolidating all of that, I mean, we've done a ton of that in the past few years, and I think we're going to continue. Consumer debt is just, it's at an all-time high. Americans don't have money in savings. And as we go into a recession, I think having cash available is a really smart move. So if that's something that you're considering or something you need to do, we do a lot of that.
Well, I think we've covered a lot of ground, but before we part, any final tips for somebody who's looking to buy a home and get their mortgage process started? Any tips for just the beginning of the process there?
There's an orange apply button at trishreedy.com. It's the best place to start.
And that was going to be my next question. Where can people find you? trishreedy.com?
trishreedy.com.
All right. Check that out. Trish knows a ton about mortgages. It's all you do. And obviously we've covered a lot of ground, a lot of stuff here. So, and there's a lot more to get into. And like you said, each person's different. Each household is different. Each buyer is different. So, that's where your expertise comes in, and you get to figure out the best deal for everybody on borrowing money.
Absolutely.
Well, Trish, thanks for being our first guest. It was a lot of fun and great information. And if there's anything else you want to add before we split?
My pleasure. Have me back anytime.
Well, we will, because otherwise it's just me. So
I'm sure you're entertaining too.
I try. All right. Well, have a good weekend spending all your PMI money, and and we'll talk again soon, Trish. Thanks so much for being with us.
Thanks, Joe.